Welcome to this explainer. Have you ever wondered what happens when two of the world's most powerful central banks make their big announcements in the exact same week, but the markets, well, totally ignore the headline numbers? Today, we're diving into a really fascinating dynamic in the financial world. We're going to decode how central bank rhetoric, the actual words they use, not just those raw interest rate figures, creates these massive policy gaps that drive the GBP, USD currency markets. We're talking trillions of dollars moving based on subtle shifts in tone. When the Federal Reserve and the Bank of England make their moves, the biggest reaction almost never comes from the decision itself. Actually, it erupts from the stark contrast between their underlying outlooks.
All right, here's our roadmap for today. We'll look at the headline versus the message, dive into the Fed's hawkish hold, explore the BoE's growth dilemma, figure out what moves GBP/USD, and wrap up with 5 signals to watch. Let's get right into it.
Section 1. The headline versus the message. So when two major central banks drop headline decisions in the exact same week, it is a massive trap for unwary traders to just look at the final rate.
The core conflict here is honestly just fascinating when you really dig into it. On one side, the Federal Reserve is laser-focused on persistent inflation, future policy uncertainty, and defending their hard-won credibility. But on the other side, the Bank of England is wrestling with a totally different beast. They're trying to tame surging energy-driven inflation while desperately managing some severe downward pressure on the UK economy. And, think about why these realities are so different. The US has a pretty solid degree of energy independence, giving their economy a nice buffer. The UK and Europe, they're way more vulnerable to global energy supply shocks. So you've got the Fed looking at economic resilience, while the Bank of England is literally staring down economic weakness. They might be making decisions at the exact same time, but man, they are operating in entirely separate universes.
Moving on to part 2, the Fed's hawkish hold. Let's look behind that headline rate.
So, the Federal Reserve kept interest rates perfectly unchanged in the 3.50 to 3.75% range. Now, this headline move? Broadly expected by the market. No shock there. In fact, if you only looked at that top-line number, you'd probably think the Fed is just kicking back, coasting along without a care in the world. But you'd be wrong. In the world of central banking, a hold is rarely just a pause. This specific decision actually carried a much more aggressive, hawkish message than a simple hold implies. The market really had to look past the surface to see the real story brewing in Washington.
And here's the crucial detail hiding right behind that flat rate: deep internal division. Get this, 3 policymakers actually voted for a quarter-point rate increase. This split is incredibly important because it exposes a deep, hawkish anxiety about inflation lurking right behind that headline number. It shows us that consensus is fraying, and the fear of rising prices is very much alive and well inside the Fed's boardroom. I mean, when 3 members break ranks to vote for a hike, that is a massive flashing warning sign to the market that momentum is leaning heavily toward tightening, not loosening.
And the underlying data absolutely backs up this caution. The Fed is looking at solid economic activity and a surprisingly resilient labor market. That basically gives them the runway to keep rates high without immediately crashing the whole economy. But they also see that inflation is stubbornly stuck above their 2% target. Throw in some complex energy supply pressures and ongoing geopolitical uncertainty, and, well, the inflation outlook gets incredibly messy. So, for anyone trading the dollar, the main takeaway is crystal clear. Restrictive policy is sticking around. They are absolutely unequivocally not ready to declare victory over inflation, and they're making sure the market knows it.
All right, Section 3. The BoE's growth dilemma. Let's talk about their balancing act.
Now, completely unlike the US, the UK is dealing with a radically different economic picture. They're getting hammered by massive global energy price shocks driven by geopolitical tensions and supply disruptions. Because of this, the Bank of England is walking a terrifying tightrope. Yes, they have to control inflation, but, and this is the big but, they have to do it without putting so much pressure on the economy that they completely crush domestic activity and growth. It's an incredibly delicate and honestly dangerous maneuver. The Fed has the luxury of leaning on economic resilience. The Bank of England? Yeah, they simply do not. And that vulnerability fundamentally changes how they can talk to the market.
The Bank of England is honestly terrified of one very specific chain reaction. It goes like this. Step 1. A temporary global energy shock hits. Obviously, the bank can't just wave a magic wand and control global oil or natural gas prices with interest rates. Step 2. Those higher energy prices immediately jack up costs for households and businesses, squeezing budgets incredibly tight. Then we hit Step 3, which is the real danger zone. This is where contagion happens. The bank is desperately watching this cycle, trying to prevent those temporary shocks from mutating into permanent economic damage.
How? By fueling broader, long-lasting wage and service inflation. If workers demand higher wages just to pay for energy, and then businesses raise prices to cover those wages, you're looking at a vicious spiral. The bank has to stop that contagion, but somehow do it without killing the economic host.
Which brings us to Section 4, what moves the GBP USD? Let's look at the policy gap effect. So think of central bank policy like an iceberg. You can have two central banks that both keep interest rates exactly the same, yet they're sending totally opposite signals. The rate decision itself, that's just the tip visible above the water. It's the easy headline on the evening news. But right below the surface are the massive forces actually driving the market: the policy statement, the voting split, the economic forecasts, and the forward guidance. The GBP-USD currency pair is purely a reflection of expectations. It's constantly measuring the hidden policy gap between those underlying forces at the Fed and the BoE. Basically, this currency pair is a real-time tug-of-war between two massive, submerged icebergs.
And here's the exact blueprint for how that policy gap works in real time. It's basically a strategic playbook for how the pound-dollar pair reacts based on who blinks first when it comes to growth versus inflation. Let's say markets believe the Bank of England is growing more cautious on UK growth, while the Fed is determined to stay restrictive longer. What happens? The policy gap widens in favor of the US. That gives the dollar the advantage and puts heavy downward pressure on GBP/USD. On the flip side, if the Bank of England surprises everyone by sounding super hawkish on inflation, signaling that rates absolutely must stay restrictive despite the growth risks, well, that gap closes. And a closing gap gives a sudden upward jolt of support for the British pound.
This actually brings us to a really fundamental psychological shift in how you should view these events. If you want to successfully read this market, you have got to stop asking the simple question of whether a bank changed rates. Honestly, that is old news the very second it hits the wire. It was priced in weeks ago. Instead, you need to start asking yourself this: did the bank sound more hawkish or more dovish than the market already expected? Because look, if investors already fully expect a hawkish message, the pound might not budge an inch when that message is actually delivered. Volatility only really spikes when those pre-existing expectations are actively challenged or totally shattered by new rhetoric.
Finally, Section 5, Signals to Watch. How do we navigate this policy gap?
Definitely keep this checklist handy, because these 5 signals will cut right through all the market noise. First, scrutinize the Bank of England's inflation outlook. Are they genuinely terrified about that wage price contagion we talked about? Or do they actually see inflation cooling off? Second, look closely at the Monetary Policy Committee voting split. Just like those 3 hawkish votes over at the Fed, the internal division at the BoE tells you exactly where the momentum is shifting. Third, pay attention to any forward guidance about future interest rates. Are they dropping subtle hints about cuts, or are they stubbornly committing to holds? Fourth, watch the reaction in UK government bond yields. Yields act as a real-time lie detector for how much the market actually buys the central bank's rhetoric. And lastly, track the immediate direction of GBP/USD right after the announcement to see who actually won the rhetorical battle.
As we wrap up this explainer, I want to leave you with a provocative thought. The ultimate question dictating the GBP-USD pair isn't who raised or held rates this week. It's actually this: which central bank will be forced to stay restrictive for longer? The Fed is fighting tooth and nail for its long-term policy credibility, while the BoE is fighting a terrifying, energy-driven balancing act. The winner of this standoff is the one who dictates the currency market. So I challenge you, look way beyond those basic headlines, track the underlying data, and watch closely how this massive policy gap continues to unfold. Keep a close eye on those signals, and thanks so much for joining me on this explainer.